All right, folks, part 2 from chapter 6. So here we're taking a look at some items from periodic and perpetual inventory system. So on the periodic system, you've got no up-to-date records and you can't estimate shrinkage. So you could see, why would anybody do this, right? Perpetual inventory system, we have continuous tracking. We know what we should have in inventory. Obviously, it's not always 100% right, but we know what it should be. And we can estimate shrinkage. By the way, shrinkage, this is, let's see here, I'll just write it up there. This is missing inventory. That could be somebody stole it, that could be it was damaged, all these different things, okay? All right, now we're going to take a look. We're going to take a look at transactions in a perpetual system, right? So we're focusing on the perpetual system, and that's what we're going to take a look at transactions on. Okay. So here we go. Walmart receives $10,500 worth of bicycles purchased on account. So notice their assets are going up. Assets are going up. Their account payables are going up. The liabilities are going up. No change in stockholders' equity. Okay, so that's the first part of it. This is what the journal entry would look like. So we're debiting our asset, we're crediting our liability, and remember, this is an asset, it's increasing with the debit, and this is a liability, and it's increasing with a credit. Okay? Now, those bikes were sold to Walmart. Take a look at the terms here. This is kind of important to know. Okay, highlighter. They were sold to Walmart with the terms FOB shipping point. Okay, these terms imply the buyer must pay the transportation cost to a trucker. Okay, $200 to a trucker. FOB shipping point. That means as soon as they went on, that Walmart owned them, as soon as they went on the truck. Okay. So notice, here's the transaction. Cash is going down $200. Inventory is increasing by $200. So what we have here, so the cost of these bikes now, okay, turn the pen on. The cost of the bikes is $10,500 plus the $200, okay? Okay, you got to include that cost in there. The reason why is if you don't, and you're working on certain profit margins, if you don't include this right here, you're going to wind up not making the proper amount of money. Okay, so you got to remember there's delivery costs. You know, a lot of times, even like with Amazon or what have you, they tell you it's free delivery. Well, somebody's paying for the delivery. Now you may be paying more in the price to cover it or whatever. But so in this particular case, remember that merchandise that's shipped, depending upon the terms. Okay, an FOB shipping point means that as soon as the company puts them on the truck, they now belong to Walmart. So it's Walmart's job to pay for that truck to get to them. Okay, and here's our journal entry. We have inventory, which is an asset. It's increasing, and we have cash, which is an asset, and that's decreasing. All right? There you go. Question number 3. Why should shipping charges become part of inventory? Okay, just mentioned it. All right? Answer this. Make sure you write your answer down so that you can go ahead and put it on the quiz, okay, on Canvas. All right, now we're going to take a look at something called purchases, returns, and allowances, okay? Purchase, returns, and allowance. Now, basically what this is, it's you get something, you buy something, or the company buys something, and it isn't what you wanted. Maybe they sent them some of the wrong colored bikes. So in this case, they have a $500 reduction in the balance owed. Okay, so they return some of the bikes. Okay, so here's what would happen. Their inventory would go down, right? They return the $500, and accounts payable would go down. So now what happens is accounts payable. So notice here, accounts payable. Accounts payable is a liability, and it's lowering it with a debit right here, lowering that liability. And inventory is an asset, and we're lowering it with this credit right here. Move my picture over here a little bit. There you go. Okay, see? Next thing we're going to take a look at is something called purchase discounts. Okay. Now, purchase discounts, let me turn the highlighter on here. Purchase discounts, what this is all about is you're giving somebody a discount for paying quickly. So notice, there's a discount percentage offered, right? The number of days in the discount period, and then the net purchase after returns and allowances. So maximum credit period. So what this reads 2% 10, 2% 30, net 60. So if somebody purchased something on November 1st, and paid by November 30th, they'd get to take 2% off. If they don't pay by November 30th, they have to pay the full amount. Okay? So let me show you, let me give you an example here. Okay? So let's say, I need a different color here. Okay? So let's say Walmart bought $10,000. We'll make it an even number worth of bicycles. And let's say the offer was 2%, or let me erase that. Don't like how that looked. How about this? We're going to go 2, 10, and then net 30. So what that means, if they pay within 10 days, they get a 2% discount. If not, they have to pay the net amount. So for argument's sake, let's say this was August 1st when they bought them. And let's say they pay by August 9th. They pay it August 9th. So what's going to happen, you're going to take $10,000 times 2%, and that's $200. So instead of sending them $10,000, Walmart's going to wind up paying $9,800. Okay, that's how much they're going to pay because they got that discount. Okay. By the way, discounts are really important in business, and actually taking advantage of those. 2%. That's if you're saving 2% on your inventory, right? That 2% goes down the bottom line. You make more money. By the way, a lot of people, especially smaller businesses, don't manage to do this. By the way, if they didn't pay by August 9th, right? Let's say they waited till August 31. August 31, they would have had to pay the whole $10,000. Okay? So if you pay quickly, you get the discount. All right, now we're going to take a look at some sales transactions using that perpetual inventory system. Okay? All right, so merchandisers record revenue when they fulfill their performance. So basically, once they've given you the merchandise, right, then they're going to record their revenue. Okay, so that's kind of an important thing. Remember, this is the one where it pretty much happens right at the same time, right? So right here, they record revenue when they fulfill their obligation. Okay, record revenue when they fulfill their performance obligation. Okay, so here they were talking about before, they mentioned FOB shipping point. Okay, so let me change the color of this. This is important. It's going to be on your test. FOB shipping point. That means as soon as the item, if the sale is recorded, when the seller loads the goods onto the truck. Okay, so as soon as you put the item on the truck, it becomes the customer's stuff. FOB destination means not until it's recorded when it actually arrives at the premises, okay, at the buyer's premises. Okay, so those are two different things. All right, so one, FOB shipping, like the example they gave before on the bicycles. That means as soon as the company put those bicycles on the truck, those bicycles belong to Walmart. If it was FOB destination, they wouldn't belong to Walmart until they were actually received at Walmart's store or place of inventory or what have you. All right, folks, that's part 2. We'll be back with part 3 in just a minute.